Okay, in this question, we're marking to market a eurodollar futures contract, short futures position. Short meaning that if the price goes up, we actually lose money, and if the price goes down, we gain money. Now, the price, it's an IMM index, is what it's called. IMM index tells you the rate of discount. Basically, IMM is defined as 100 minus D, where D is a rate of discount. Rate of discount is really a method of pricing something. The price of these things is going to be, in general, the face value times 1 minus dt over 360. Why 360? Well, because we've been trading these things for more than 100 years before calculators were around, so it's traditional. Also, it's easy to price. For example, if the eurodollar futures contract is for a 90-day eurodollar CD, so T would be 90, and anyway, this is how they're priced. The tick size, it says, is 25, which is what you get from 1 basis point change. That is, if I put in their $1 million face value, and 0.0001 would be 1 basis point, 1/100th of 1%, times 90 over 360. It's going off the page there, but and that will give you $25. So that's where the tick size comes from. Anyway, that's the tick size is given. You don't have to figure that out. Also, the initial margin is given as $3,000, and the maintenance margin is $2,000. The initial margin is what you need to establish your position in the first place. It's a deposit, although it can be interest-bearing. But at any rate, it's a deposit that is required to open the position, and the 2,000 maintenance margin is really just a trigger. If your margin account falls below that maintenance margin of 2,000, then you would receive what's called a margin call. Perhaps if you seen the movie, say, Trading Places, for example, there's an example of a margin call there where the Duke brothers get creamed. If you've never seen it, then never mind. But anyway, it's just a trigger. So I've written the information down here, what they gave us. They gave us the futures prices. Initially, it was $94.75. And then after that, when you first establish or originate your contract, your short futures, at the end of trade on day 1, the settlement price is $94.50. Day 2 is $95.00, $95.25 after 3 days, and $94.75 after 4 days. Initial margin account balance is $3,000, as we said. That's just to establish it. and now we start the clock. We have the short position, 1 eurodollar futures contract. After 1 day of trade, the price went down from 94.75 to 94.50. That would be 25 ticks down, which is good for us. That's going to be a plus 625. That is $25 times 25 ticks. 75 minus 50 is 25. So our margin account balance actually increases by $625 to $36.25. And so far we've only spent $3,000, and we'll get that back at the end. Another day goes by. The settlement price at the end of trade on day 2 is $95.00. That went up. It went against us. It went up by 50 basis points from 94.50 to 95.00. So 50 basis points. 50 times 25 is 1250. So we lost 1250 there. So 36.25 minus 1250 gives us 23.75. And so that's the end of day 2. It's still above our maintenance margin of 2,000, so we're not required to do anything. It's just that our margin account is now down to 23.75. Now on but we still have our short position. Now day 3 trading commences. It goes up and down. At the end of day 3, we have a settlement price of 95.25. So that went up against us again because we're short, up by 25 more points. We have another minus 625. That's $25 times 25 basis points. At that point, that brings us 23.75 minus 675 equals, well, it would be 1750. But that's below the maintenance margin of 2,000, so we would receive a margin call at the end of the third day of trade. If we want to continue our position into the fourth day, we would have to bring, the margin call requires that we bring our margin account balance back up to its initial margin. So that is, we deposit whatever it takes to get us back to the initial margin of 3,000. So that would be 1250. So we're going to deposit 1250. That brings us up to 3,000. Okay. Well, yeah. It's not a marked. That's not, the 1250 is not a mark-to-market cash flow. It's margin call cash flow. So I'm putting it in a separate column. So we have 3,000 again. Now we can continue with our position. Day 4, we have the price goes down from 95.25 to 94.75. That's down by 50 basis points, and that's good for us. We're short. We have a short futures, so that's going to be plus 25 times 50 is 1250. So you gain 1250, and that brings our account balance up to what? 3,000 plus 1250 is 4250. Now these are the marking-to-market cash flows right here, but also there's a margin call at the end of day 3 requiring us to deposit another 1250 into our account. That essentially answers the question. We can also see though that our net cash flow, sorry about that, our net cash flow, well, we had to deposit 3,000 at the beginning. We also were required at the end of day 3 to deposit another 1250 due to the margin call, and then at the end of it, assuming we close out our position at the end of day 4, we get a positive cash flow of 4250. We can drain our account and close our position, and you can see that adds up to 0, which is kind of what you would expect given that the futures price when we first sold futures was 94.75, and the futures price when we exited our position or terminated our position was also 94.75, so it would make sense that the net cash flow is 0 since the futures price didn't go up or down.